if you look at the value of a basket of commodities over a long period of time, it's remarkably stable priced in gold. It's when you price it in fiat currency that it's volatile and tending to rise over a long period of time. And now we are seeing commodity prices rising. Gold is going with that flow. Whether it's driving it or not is not the material point. The point is that people are getting out of credit into something solid, which is, in the case of, the Asian hegemons, is basically commodities. So we're looking at about $130 trillion of credit, currency and credit. And that's why, incidentally, the gold price is looking remarkably strong. It's not that gold's going up. It's just that foreigners would rather have gold than dollars.
Recent data pointing towards a potential hard landing in the U.S. economy has sparked a surge in interest among gold investors, who are turning to the precious metal as a haven asset. Alasdair Macleod, head of research for Gold Money, contends that a notable transition is underway as investors pivot away from credit-based assets towards tangible ones like physical gold. This shift, he argues, is propelled by the inherent instability of the credit system. Despite some expectations of rate cuts being scaled back, the price of gold has surged by 12.6% year-to-date. Notably, this increase has occurred without significant support from a pivot in Federal Reserve monetary policy, a markedly weaker dollar, or a substantial resurgence in institutional investment demand through exchange-traded funds. Macleod anticipates that this shift will drive inflation rates higher, despite official government statistics, such as the Consumer Price Index, potentially masking the true extent of inflation. He posits that the devaluation of credit will ultimately fuel inflationary pressures. In response to market speculation and data, bullion prices climbed by as much as 1% as traders analyzed policymakers' stance on the timing of potential interest rate cuts, particularly ahead of the release of March inflation data. While the Federal Reserve anticipates rate cuts this year, it remains cautious, emphasizing the need for further evidence of easing inflation. The Fed's focus on core CPI, excluding volatile energy and food prices, has revealed unexpected rises in the past 2 months, exceeding initial estimates. Macleod concludes by suggesting that we are witnessing the early phases of a substantial reevaluation of the credit system. He implies that this shift will have profound implications for the broader financial landscape, underscoring the evolving dynamics within the global economy. Come along as we explore the valuable insights provided by Alasdair Macleod. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
The only real money, and has been since Roman times, is gold. Physical gold, not paper gold or anything like that. The real stuff. There is no counterparty risk. Everything else is credit. Even equities are credit. Why is an equity a credit? I mean, you think you own an equity. For a start, you own. You don't actually own shares anymore. You owe an entitlement, which may or may not be delivered. But the basics behind owning an equity is that you're buying into the promise of an income stream, and it's that ultimately gives the value to the equity. So everything else is credit, other than gold, other than physical gold. Now, when that enormous mountain of credit becomes unstable, I mean, what do? You get out of credit and go into money. And that's basically what's happening. It's beginning. And I think this is the key thing. And of course, so few people understand it because they think the gold price is rising when it's not. It's the credit declining. And of course, it'll take time before, all the sort of statistics which everybody loves, macroeconomic statistics sort of reflect this. But you'll find that, like it's purchasing power in terms of goods and services. And as I said earlier, we're already seeing this with commodities. If you look at the value of a basket of commodities over a long period of time, it's remarkably stable priced in gold. It's when you price it in fiat currency that it's volatile and tending to rise over a long period of time. And now we are seeing commodity prices rising. Gold is going with that flow. Whether it's driving it or not is not the material point. The point is that people are getting out of credit into something solid, which is, in the case of, the Asian hegemons, is basically commodities. They're investing in commodities. They're stockpiling commodities. China is stockpiling copper. She has been stockpiling silver for a long time, though she's lost control of the pricing. And we're seeing that actually happening at the moment. Russia and all the rest of them are supplying energy. And, we're trying to deny that this energy has any value. We're saying it's nasty stuff, but we can't do without it. As I said earlier, WTI has gone from 68, 69, it's now 85. this has an effect. So what you are seeing is you will see this come through in higher rates of inflation, which is a joke. CPI inflation rate is something which is made up by governments. It suppresses really what's going on. But anyway, we'll put that argument aside. The fact of the matter is credit is losing value. And when people actually understand this, they will run for the doors. They will get out of credit wholesale. And it'll start with the foreigners. It usually does. Foreigners who hold on to someone else's currency for whatever reason. I mean, the case of owning equities, I think they've got about 14.5 trillion in equities, in US equities. That is a speculation. I mean, that is all it is. You can dress it up and say that this is international diversification, portfolio diversity. It's speculation. And the moment that goes wrong, what will the foreigners do? They'll just get the hell out, save what they can. And rising interest rates will trigger that. I think we are actually in the early stages of a major shift in value for the whole of the credit complex.
Inflation has emerged as a persistent concern since the onset of the COVID-19 pandemic, with price hikes reaching levels not seen since the early 1980s. In response, the Federal Reserve implemented a series of interest rate hikes, pushing its benchmark rate to its highest point in over 22 years. The sharp increase in interest rates had a cascading effect on consumer borrowing costs, leading to significant financial strain for many households. While 15-year and 30-year mortgage rates are typically fixed and tied to Treasury yields and economic conditions, prospective homebuyers have faced a notable erosion of purchasing power, driven partly by inflationary pressures and the Fed's policy adjustments. In anticipation of further interest rate increases, Alasdair Macleod highlights the potential exposure of malinvestments, particularly within sectors such as commercial real estate and private equity. He cautions that higher rates are likely to unveil unsustainable leveraged positions, posing risks to financial stability and investment portfolios. Let's get back to the interview.
If you look at the US, a lot of the economy is just hot air. It's hot air because the government is spending, on my estimates, somewhere between 3 and 3.5 trillion, which it is funding out of thin air. Unless you see a significant increase in personal savings in the US, which we're not, it's going the other way. The GDP is being bolstered by this. The idea that the economy is resilient is hogwash. It's not resilient at all. The only reason GDP is holding up is because the government is spending like a drunken sailor and not productively. I mean, people do confuse a progression, economic progress with GDP. GDP is just, all it does is it measures the value of the transactions. It doesn't tell you what the quality of those transactions are at all. So the US economy underlying this, when you allow for all this government spending and excessive regulation and everything else that the government throws at the economy is actually in a pretty poor state. And not only that, it's over leveraged. We will see interest rates rise, and that's going to expose a lot of malinvestments. We already see this with the commercial real estate side. We see this with the private equity business, which basically, buys steady income stream and then leverages it up. That's now coming up for refinancing. I mean, in England, we've got Thames Water, which is an absolute classic case of this. Higher interest rates are here to stay because of what interest rates do. Interest rates compensate foreigners for the risk of holding a foreign currency, i.e. dollars. And, unless you give them the compensation, they're not going to hold it. They'll sell it. And they've got 32 trillion in financial securities and bank deposits. There's an additional 10 trillion offshore in the euro-dollar market. And then there is all the dollars, if you like, which intermediate in foreign currency transactions. I mean, for example, if you sell euro and buy yen, you sell euro, buy dollars, sell dollars, buy yen. So the dollar is always in the middle, and that is estimated by the Bank of International Settlements to be a further 85 trillion. So we're looking at about 128, 130 trillion dollars of credit, currency and credit, which nobody's going to want. So what happens to its value? It, goes, I'm afraid. And that's why, incidentally, the gold price is looking remarkably strong. It's not that gold's going up. It's just that foreigners would rather have gold than dollars.
Recent market data and analysis suggest a shifting landscape in the global economy, marked by heightened concerns over inflation and the stability of the credit system. The surge in interest among gold investors reflects a growing appetite for safe haven assets amidst economic uncertainties. Will the rise in interest among gold investors persist, and how might it impact traditional investment strategies? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.